Hello all, this is going to be your review quiz for your quiz on the statement of cash flows or your Chapter 16 quiz. I'm asking you to prepare a statement of cash flows via the indirect method. Today I'm going to be working in Excel. You don't have to, but it is a very useful tool to help you out. To prepare our statement of cash flows, we're going to need three things. The first thing that we have is our income statement here for our company, which is called Jackson Educational. We're also going to need a comparative balance sheet. This is a balance sheet with the assets, liability, and equity accounts for the company for the last 2 years. We have their 2018 and 2019 numbers. And then lastly, you are going to need any additional information that is going to help you prepare this statement. In this case, we have two things: that Jackson Educational has purchased $28,200 worth of land by signing notes payable with a local bank, and that they discarded a plant asset for $0. They just got rid of it, and at the time they discarded it, the book value of the asset was $12,630. To prepare our statement of cash flow is going to look a little something like this, and we're going to start with our operating activities. These are things that happen during our everyday course of business, and because we're using the indirect method, the first thing that we are going to start with is our net income. And to find that, you just steal that number right off of the income statement. So for Jackson Educational, if we go to their income statement, we see at the bottom they had $110,100 worth of income. We'll just grab that and bring it on over to our net income. To this net income, we need to make adjustments so that our net income lines up with the cash that came in and out. Income can be manipulated by a lot of accounting methodology. If you change your depreciation method, if you change your revenue recognition method, you're going to end up with income that doesn't line up with the cash that is coming in to your company. So we're going to adjust our net income to the actual amount of cash that we received during the period. And to do that, the first thing we need to do is add back in our depreciation expense, because depreciation is a non-cash expense. So if we go to our income statement, we can locate our depreciation expense right here was $14,800. Let's add that back in to Jackson Educational's statement of cash flows. The next thing we need to do is adjust for the changes that we had in our current assets and our current liabilities. The first thing we had is an increase in accounts receivable. On a statement of cash flows, if you have a current asset that increases, it actually decreases cash flows. Why? We'll think about it this way. If we did the same amount of business and our accounts receivable went up, that means that we got less of our payment from the things that we do in the form of cash. So an increase to AR is actually a decrease to cash. To grab that number, we're going to go to the balance sheet and grab their 2019 number. And we see right here that they had $25,600 in 2018, and they had $26,600 in 2019. That means that we had a $1,000 increase between these two numbers. So if we just take that difference, we have our $1,000 increase. But like I said, an increase to accounts receivable actually decreases our cash flow. So let me just go really fast and make this negative. We have negative $1,000 of cash flows because our AR went up, less of our customers paid us in cash during the period. Next, we have a decrease in merchandise inventory that happened, and we see that on the balance sheet. It went from 91,000 all the way down to 79,200. So let's grab that difference on our statement of cash flows. And 91,000 minus the 79,200 means that our merchandise inventory decreased by 11,800. This can mean one of two things. Either we sold more during the period, which means we would have got more cash, or our decrease in merchandise inventory means that we purchased less inventory, in which case we would have sent out less cash. So a decrease to a current asset increases cash flow. Next, we have an increase in accounts payable. So let's go back to our balance sheet, and we see right down here that accounts payable was $30,600 during 2018, and it has increased up to $34,900 in 2019. So we can fill in our statement of cash flows by taking this increase in our accounts payable. Accounts payable went up by $4,300. So for liabilities, when a current liability increases, your cash flow increases. Again, using this same methodology. If our accounts payable went up, it means we owe more money. Well, if we did the same amount of purchasing for things and our liability went up, that means we paid less in cash. So an increase to a current liability is also an increase to cash flow. For accrued liabilities, things like salaries payable, interest payable, utilities payable, etc., we're going to have a decrease. And if we go to our balance sheet, we see that the decrease that we had in accrued liabilities that went down from 30,700 all the way down to 28,500. And if we go in and we take that difference, I'm getting there. We had a $2,200 decrease in accrued liabilities. Well, same theory here. If our accrued liabilities went down, we owe less money, which means we must have paid more things off in cash. So a decrease to accrued liabilities is also going to decrease cash flow. So let's just go and make that negative really fast. And now we've got a $2,200 decrease to cash flows. For our adjustments, you just add up all of the numbers that are in the left-hand column right now. So we're just going to take the sum of all of these numbers, and it's $27,700 worth of adjustments. So that is our adjustment to net income. To get our net cash provided by operating activities, we just take our net income and add to it the total of our adjustments. So we had net cash provided by our operating activities, the normal course of business things that we do, of $137,800 during the period. Next section we have is our investing activity section, and the only thing that we have listed in here is the cash payment for the acquisition of plant assets. So we must have purchased plant assets during the period, and if we go to the balance sheet, we see that plant assets went from $11,180 to $118,550. Well, you would probably want to go and just take the difference, but for this particular question, it's not going to work that way. And the reason being is in our info, we see that we discarded a plant asset, but it still had value on our books at the time we discarded it. Its value was $12,630. So how much cash did we actually pay for plant assets during the period? Well, let's use this handy dandy little formula up on the top. Let's take the beginning value of plant assets at the beginning of the year. Let's go to our balance sheet. If we ended 2018 with $111,180 in plant assets, then we must have began 2019 with that same amount. So let's bring that number over, and let's subtract out the book value of our disposed assets. And again, our info tells us it was $12,630. So if we go back to our formulas and we'll just type that in, means we got rid of $12,630 from our books. Well, that means that our assets that were still in service, that were on our books at the beginning of the period, has to be the difference between these two, or $98,550. Well, let's go find the ending value that we had. And if we go back to our balance sheet, we see we ended the year with $118,550. Bring that number. So we started with $111,180 worth of plant assets, but we got rid of $12,630 of book value for those assets, which means at some point the book value of our assets must have been all the way down to $98,550. And if it ended at $118,550, well, that means we must have paid out some cash in order to acquire more plant assets. How much? Well, it's just the difference between what we ended with and what the book value of our beginning assets still in service was, which $118,550 minus $98,550 means we spent $20,000 to acquire plant assets during the period. So if we go to our statement of cash flows and we go right here and we fill in the cash payment for the acquisition of land, well, that is equal to at $20,000. But we paid it out, which means if that money is coming out of the company, it must be decreasing Jackson Educational's cash flow. So let's make that negative. And our net cash, since that's the only thing we had used for investing activities, is also going to be a $20,000 cash outflow. Which brings us to our third section of our statement of cash flows, which is our cash flows from financing activities. These are the things that we use to raise capital for the company, things like signing notes, issuing bonds, issuing stock, etc. And it's all the subsequent costs as well. So the cash payment of dividends is going to go in here. And let's start with figuring that one out. How much did we pay for cash dividends during the period? Well, we've seen a statement of retained earnings before. And we know that for retained earnings, it's always your beginning balance of retained earnings plus your net income minus the dividends or withdrawals from your company that you paid to give to owners gives you your ending balance of retained earnings. And we can use this formula to figure out how much we paid in cash dividends. So our beginning retained earnings, according to our balance sheet, was $3,300. Not very pretty. And we had net income during the period. How much? Well, we can find that on the bottom of our income statement, $110,100, giving us a subtotal of those two numbers added together. $113,400 is the amount of internally generated profit that we had during the period, considering what we carried over from last period. At one point, we had $113,400 worth of retained earnings sitting around waiting to either be reinvested in the company or paid out to our investors in the form of cash dividends. Well, how much did we pay out? We can figure that out by going back to our balance sheet and figuring out what we ended with retained earnings. So retained earnings had an ending balance of $44,700. We're going to bring that number over. If at some point we had $113,400 worth of retained earnings and we only ended up with $44,700, well, that means the amount of dividends we paid had to be the difference between those two numbers. So if you take this subtotal and subtract out your ending retained earnings, you're going to find out that Jackson Educational paid $68,700 worth of retained or worth of cash dividends, during the period. If we go to our statement of cash flows, we can go and we can just fill that number in, $68,700. And again, we took this money out of the company and gave it to our stockholders, which means it has to be a negative cash flow or a cash outflow, if you will. So we paid $68,700 for dividends. Next up, we have the cash payment of notes payable. And we have a little formula for this. To figure this out, let's start with the beginning balance of our notes payable according to our balance sheet. So we go back to our balance sheet. We find the original amount of notes payable was $105,000, and we need to add to that any other notes that we signed during the period. Well, fortunately, we have this in our information. The first thing tells us that Jackson Educational purchased $28,200 worth of land by signing a note payable with a local bank. So let's go back to our formula and add in that $28,200, which means at some point we could have had $133,200 worth of notes outstanding, but that's not what we ended up with. What did we end up with is our ending balance of notes payable. Well, if we go back to the balance sheet and we go and we find notes payable, we only ended up with a $72,000 balance that we owed at the same period. So if we hypothetically could have owned $133,200 at some point during the period, but we only owed $72,000 at the end of the period, that means we must have paid the difference between those two numbers in cash to reduce our liability during the year. $61,200 was our payment. So if we go back over here and we grab that $61,200 cash payment for notes payable, same concept, we're paying this out of the company to the bank to pay off our liability to them, so that has to be a cash outflow as well. We're going to make it negative. And then the last thing we have is our cash receipt from common stock issuance. We can figure this out by going to the balance sheet. And if we head over to the balance sheet, we see right here we have common stock that went from $64,800 up to $88,000. Well, that's simple enough to throw into our statement of cash flows. It's just got to be equal to the difference between those two numbers. That's the amount that our common stock went up by. And because we are issuing this stock to the public to raise money for our company, that means that it has to be a cash inflow and therefore would be positive. So our cash used for financing activities is just going to be equal to the sum of those three numbers. And and that is a cash outflow of $106,700. To find our net increase or decrease in cash, it is simply the sum of your three different categories: operating, investing, and financing. So we're going to add those three together. Let's take our $137,800 in operating activities, add to it our negative $20,000 for investing activities, and add to it our $106,700 cash outflow for financing activities. And we come up with a net increase in cash of $11,100 during the year. Well, is this right? It's simple enough to check. If we go to our balance sheet, we have cash listed. Did our cash increase by that amount? It absolutely did. That is a $11,100 increase. Well, let's disclose that on our statement of cash flows. So on 12/31/18, the end of last year, we had $15,100 for the cash. We're going to bring that over. And on the last day of this year, 12/31/19, we're going to go back over to our balance sheet and see that cash increased to $26,200. Again, that is an $11,100 increase, which matches the net increase that we got up here by adding together our cash provided by operating activities, our cash used for investing activities, and our cash used for financing activities. We're almost done. We only have one thing left, and that is any non-cash investing or financing activities. Users of our information are going to want to know why certain accounts changed. That doesn't reflect the way that our cash account changed. And in this case, we do have one thing in our piece of info that we need to disclose to them, and is that we purchased $28,200 worth of land by signing a note payable with a local bank. That's a non-cash activity. We didn't exchange any cash to them. We just signed the note. So down here on the bottom of our statement of cash flows, we are going to tell people that $28,200 of land was acquired. Don't have my thing properly formatted. Let me fix it really fast. Was acquired by signing this note payable, which means our total non-cash investing and financing activities had to be $28,200. Best of luck on your quiz, everybody. Let me know if you need help. You can contact me by email at any time. Have a good day.